banks will fail. I'm your host, Steve Van Meter, and thanks for joining me today. And Jaime Dimon is warning Congress that unless changes are made, we're months away from seeing major lending institutions fail. Let's head over to Bloomberg, where we picked today's story up as Dimon blasts higher capital requirements as bank CEOs head to Washington, saying that the increase is, quote, bad for America. Dimon, the longtime chief executive officer of the biggest U.S. bank, is appearing in Washington today and on Thursday. In his prepared remarks, he touted that the role his firm plays in the global economy and warned of harm from arbitrary increases in capital requirements. The continued upward trajectory of regulatory capital requirements on America's already fortified largest banks, particularly when not reflective of actual risk in itself, is becoming a significant economic risk, Dimon wrote. This is bad for America as it handicaps regulated banks at precisely the wrong time, causing them to be capital constrained and reduce growth in areas like lending as the country enters a difficult economic conditions. And what he's referring to here is that the banks in America are actually capital constrained. They're regulatorily constrained. They're not lending as much as they need to, because what are we seeing right now in the broad economy? Well, when we look at the dollar, we've been talking about on the show that we're seeing a dollar shortage. Well, how are dollars created? Well, when the commercial banks lend. So he's saying, Congress, hey, these regulations you put on us are causing problems. We can't lend. This dollar shortage is only going to get worse. And that, my friends, will lead to bank failures. New York-based J.P. Morgan temporarily suspended share buybacks in July to quickly meet higher capital requirements tied to harsher stress test results and a previously flagged increase to its buffer for systemic importance. Dimon has long criticized capital requirement increases, arguing among other things that they put U.S. banks at a disadvantage relative to international competitors. And he's right, this is true. And this is where we hear from our chief strategist, Jeff Snyder, talk about the Eurodollar system, which is nothing more than a dollar that's in an offshore bank. Anywhere outside the U.S. has nothing specifically to do with Europe. But why does that matter? Why does he talk about that so much? Because that is where dollars are created, because the U.S. banks are indeed constrained by these regulatory requirements. So it's not just about corporate share buybacks, which is what everyone thinks this is all about. It's really about the fact that we need the major U.S. commercial banks to do what they're supposed to do, and that's lend. Michael Barr, the Federal Reserve's vice chair for supervision, has said that U.S. officials are reviewing bank capital requirements and are committed to putting in place structures that align with the global Basel III standards. Barr, who took over as the Fed's top bank watchdog in July, has also signaled that he supports tougher restrictions for bigger, systemically important lenders than smaller institutions, telling Jaime Dimon that, hey, bud, you're probably not going to get what you want, but you can keep trying. But what is Jaime referring to? Well, let's go back in time and look at the Fed, because I want to show you why we're going to see a lot of bank failures, but you need to understand the setup to what's really going on here. Back in March 19th of 2021, the Federal Reserve announced that the temporary change to its supplementary leverage ratio, or SLR, for bank holding companies will expire as scheduled on March 31st. And we covered this way back then, but to ease the strains in the Treasury market resulting from COVID-19 pandemic and to promote lending to households and businesses, the board temporarily modified the SLR last year to exclude U.S. Treasury securities and central bank reserves. And since that time, Treasury market has stabilized. Since then, some people say not stable at all. But they did this because the recent growth in the supply of central bank reserves and the issuance of Treasury securities, the board may need to address the current design and calibration of the SL over time to prevent strains from developing that could both constrain economic growth and undermine financial stability. So what's happening now since then? Are we seeing obviously this build in bank reserves? No, the Fed's not doing QE, they're doing QT. And what about debt? Well, is the government issuing as much debt as they were back during the pandemic? Nowhere even close. So now you see why the banks are going to Congress saying, look, there's a big problem here. But wait till we connect the dots and you'll see this is indeed bad news for a lot of lenders. To ensure that the SLR, which was established in 2014 as an additional capital requirement, remains effective, get this, in an environment of higher reserves. Remember, we just said the Fed is doing QT. They're draining reserves. The board will soon be inviting public comment on several potential SLR modifications, none of which we've heard from since then. And if you're wondering what this is all about, what this SLR thing is, we head over to the Bear Traps Report blog, which notes that with TGA or Treasury General Account cash coming in by the summer, this is going to, again, referring to years before, to the tune of $1.1 trillion per the current TBAC schedule or lending schedule of the government, the bank SLR defined Tier 1 capital divided by on and off balance sheet assets will decline. This is because, here's the key part I want you to understand, deposits will come in and cash will go up at banks, and cash asset is in the denominator of the SLR calc. As a result, U.S. banks won't have room to accommodate the cash deposits. The SLR could trip minimum requirements, and so what happens is banks get actually penalized for holding all this cash. Now, if you've been wondering, hey, why aren't banks offering competitive interest rates to, say, to money markets? Because they don't want your money. They are being constrained by these regulatory requirements, and they'd be more than happy if you closed your account and moved it somewhere else. They wouldn't stop you. Again, it's because of all this regulation that many now are arguing we don't need. But I want you to understand there's some serious ramifications of this. And as we go back to the Bear Traps report, no SLR relief means banks must turn away deposits. There we see it. And then where there's nowhere for money market capital to reinvest, think reverse repo. This is, again, the Fed's growing $2+ trillion balance sheet that they're backstopping the entire money market. And you're seeing it in real time. This is why that money market mutual fund bill maturities flood more cash. So entire money market constellation trades close to zero or lower, and banks can't buy treasuries. So there's no more room on their balance sheet due to the SLR. So they're start puking them out. Trouble, he says, and there's your point as we start to understand, is that all this regulation is indeed causing problems in the U.S. banking system. But there's one thing that shouldn't go puking should the banking system crumble down into a recession, and that's your portfolio. I'll put a link up here to Portfolio Shield and description below, because now let's take a look at what the banks are doing with their Treasury securities. Many thought they'd be dumping them like crazy. Well, not quite. Here we can see from the weekly 8.H, the most recent one, we look at non-mortgage-backed securities or U.S. Treasury securities at the major commercial banks. And at their peak in June, they were sitting at $1.749.6 trillion, now down just a little bit over $50 billion to $1.695.8 billion. But many believe that if it wasn't for the SLR issue still being a problem, that the banks would actually be buying Treasury securities, and that would bring rates down quite a bit. And now we start to get to the real issue here, is what's going to happen if rates still stay high and they don't come back down quickly? Well, a lot of non-bank lenders are going belly up. And here's a list of the top non-bank financial institutions. Now, we're not going through the whole list. We'll go through one of them, because what's a non-bank financial institution, you ask? Simple. Any bank that doesn't have deposits. They do banking stuff, but they don't take deposits. Who is the big one on the list? Well, you might know them by the name of Quicken Loans, or if you've had a refinance recently, you might have actually quoted out with Rocket Mortgage. And so now we're starting to see what the issue is, because these companies, all they do is lend. And if lending demand goes down, then what's going to happen to non-bank lenders? See, JP Morgan, Bank of America, Wells Fargo, they'll be all right, most likely, even if we do have a financial crisis. But what about all these non-bank lenders? All they do is originate loans and sell them. That's how they make money. They don't have deposits, don't have any other business. And if we don't see rates come back down, if Congress doesn't maybe do anything, or we don't have some sort of pivot by the Fed, what you're going to see is one non-bank lender after another in the months to come outright fail, and you'll see why here in a second. Applications of refinance a home loan, which are usually very sensitive to big rate swings, actually rose 10% for the week, although we're still 83% lower than the same week a year ago. So again, I want you to think that these non-bank lenders have 83% less business. If you had a business and your business had dropped, your demand for your product or service fell 83%, you're not probably going to be in business much longer, and that's the case here. We're going to see a flood of non-bank lenders fail, and that's just going to mean more people on the unemployment line. And part of that may be due to the holiday adjustment the previous week. It also may have been that very few borrowers remain who could benefit from a refinance. As I pointed out repeatedly on the show, that finally got off the fence is there's very few people who can borrow at these higher rates, and seeing that rates may climb even higher. But is that likely? The answer is no, but we'll first see if there's more damage going on in the bank as the biggest U.S. banks scale back on property lending as rates climb. After a record first half of 2022, the biggest U.S. banks have become more selective, as we've talked about on a recent show, on commercial real estate financing deals. And there is a reason why for this, and let's take a look, because it has everything to do with the Fed and what they're doing right now. Banks including Wells Fargo, Bank of America, and JP Morgan Chase have pulled back on financing for offices and other commercial real estate following a record burst in lending in the first half of the year. The biggest U.S. lenders, which include Morgan Stanley and Goldman Sachs, have become more selective and stiffened borrowing terms. Tightened lending standards while issuing fewer new commercial property loans, according to people familiar with the matter. Well, we don't need to be familiar with the matter. You just need to look at the fact that we look at this chart here. We have in blue the net percentage of domestic banks tightening standards for commercial industrial loans, and we see when it goes up across this black line, it means that financial conditions are tightening, and that means that they're being more selective about who they lend to. And below that, we've got the yield curve in red, which is a 10-year Treasury minus the 2-year Treasury, with the baseline being this yellow line, that when it gets down here into this inversion, remember, banks borrow at the short end, lend at the long end. So in fact, when you see short rates higher than long rates, banks don't make money lending. So if that's your business and you don't make money doing it, what are you going to stop doing? You got it. You're going to stop doing it. Or if your margins are just right, just tight enough, you only lend to people you're sure will pay you back. But check this out. Because when you see the curve start to invert, what do you note? You see lending standards tighten, and then all of a sudden, as they continue to get tighter, all of a sudden the curve steepens and rates come collapsing down. And even as lending standards ease a bit, they're still tightening. Anytime it's above the black line, they're tightening just at a slower pace. You can see that rates come crashing down, indicated by a rising Treasury yield curve. And so that brings us to the Fed meeting today, who announced they're going to raise policy rates by 0.75% and continue tightening this inversion. But Powell made one more very important comment today about what his plans are. And to that, well, we'll go to me. And here on this tweet, he quoted, "Until the job is done, only pain will you find," says Yoda. And that is absolutely right, because as long as the Fed continues to raise short-term rates, they're going to continue to keep that curve inverted until something in the system breaks. And that means, of course, what we're going to see is banks are going to keep tightening financial conditions. And I know a lot of people say that rates can't go down, but if you understand the relationship between how money is created and what the banks are doing by tightening lending standards, the only way rates can eventually go is lower, because you need them to fall to spur the creation of new money. Otherwise, you have an outright crisis or some other doom event that is likely to come. But I want you to see just how big of a player the Fed is in tightening lending standards. Here now, we'll take that same chart before, we'll remove the yield curve, but we'll now overlay the federal funds rate in red. And notably, when the Fed starts to raise rates, what happens? The banks start to tighten lending standards. And so again, as you can see, as the Fed tightens here, it only gets worse for the banks, but it doesn't mean the bond market can't shift. To that, let's head back over and talk about our chief strategist, Jeff Snyder, who writes in his daily that, mind you, is still free, very limited time now, as we count down to the October 1st launch. MarketsInsiderPro.com. Get on the list before it's gone. Let's see what he had to say. When it refers to Treasury demand, he notes for the bond market gurus out there, they condense Treasury and other government bond yields into a simple case of supply versus demand. He goes on to say, on the contrary, foreign private participants have been buying long-term U.S. Treasuries at extortionate rates, and at $623 billion from the end of October, when the curve started really flattening, and the end of July, according to the latest data, after it went inverted. Why? He says, well, liquidity fears that go along with a fundamental liquidity purpose, those tuned exclusively to the Fed cannot comprehend. Demand is there and has been there, and history repeatedly shows us why it is and will stay. Again, it has everything to do with how the financial system works. You get these periods where the dollar gets too strong. It's because there's a shortage. Rates ultimately have to fall. Smart investors realize that, and that's what they see when the curve inverts. They're big buyers. But now you can understand why we're likely to see a whole slew of non-bank failures, because rates are too high and demand for loans way too low, and the Fed can't pivot fast enough to save them. I'm Steve Van Meter. Thanks for watching. Thanks for being fans. Bye now.